get back here. Really appreciate it. Good evening, everyone in the chat here. My name is Steven Briggs. I am the owner of Briggs Financial. Briggs Financial is a independent financial planning firm. We've been, started up in early 2018, so finishing up 3 years in business and serving over 100 households now. Just hired a new team member on our team full time. So we're growing. We're helping lots of people with everything personal finance related. We are completely in the advice space, so we don't sell like insurance or do annuities or any of that stuff. But I got in this business, bottom line, to help people figure out their finances. I'm a teacher. I was a teacher originally by profession and continue to be a teacher at heart. And this financial stuff and doing stuff, whether it's with Medicare, Social Security, figuring out that pathway, it's challenging. There's a lot of information out there. Some of it applies, some of it doesn't, some of it's outdated and so forth. So tonight's presentation is really designed to do a couple of things. One, it certainly spells out a lot of information when it comes to this topic, and it is not an easy topic. It's not easy for anyone to navigate this and figure out, the best way to go about this. And so to that end, I'm hopefully will bring up a number of topics that may apply to you. But that said, every single person's individual situation is completely different from one person to the next. We all have different life circumstances going on. So to that end, what I would say is that if you have some specific questions, you can certainly, they can go into the chat and I'll try to answer some things. But in many cases, what I would also recommend is either reaching out to us via email, and I'm going to put our email in the chat here real quick. My email specifically, Steven@briggswealth.com. Feel free to reach out. Doesn't cost anything to do it. Happy to try to answer those questions. I also strongly recommend contacting Social Security. Those people are there to help you. Like, it is their job, mission, priority. This is what their career is helping you and helping you navigate this stuff. And they're going to be able to pull up, in many cases, they're going to pull up information that even I as a planner can't pull up with respect to income, work history. Sometimes there are a couple of interesting rules that they may have more information on than you do. And so to that end, I strongly encourage using those resources as well, please. So without further ado, though, let's go ahead and dig into maximizing your Social Security benefits. First thing I want to talk about is, why is this so important? Well, the bottom line is that right now, more than 1 in 3 people currently age 60 or older is going to reach age 90. JP Morgan just did a recent study that said that this year we've crossed a threshold where if you're 65 now, you have a better than 50% chance, if you're married, of one of the two of you making it to 90. And actually, the way the numbers are going by the wonders of modern science and everything else in medicine, 1 in 7 are going to reach age 95. So the thing is, a lot of the assumptions that you probably have seen throughout your career and in different information about this stuff, people retire at 65. They, and then that all worked when people were regularly expected to live till age 80. Thing is, a lot of people are living a lot longer than that now. And so we want to make sure that when we're thinking about your expenses, when we think about your ability to live your lifestyle, maintain independence, whatever those goals are for you in this next phase of life, that you have the resources to handle that. And the bottom line is, for most people, you're not going to be earning typically more income than what you make going into retirement. My parents are an odd exception in that regard, the way that their retirement worked with their respective jobs. But by and large, that's not true. And so taking some time to really map out, where is income coming from, what sort of expenses can you expect, and really looking at it and making sure that this thing's going to sustain you for the long term and not trying to make any assumptions about, I remember when I was little and growing up, my great grandmother on my mother's side would basically tell my grandmother every day that she was going to die tomorrow, and so she's smoking and drinking and all of that, and she lived to be over 100, and and so bottom line is that we don't know what's going to happen in our lives one way or the other, so it's important to make sure that we're prepared, and that way you get to live the life you want to live through that. So one of the topics that comes up is when should I take Social Security? And it's true that you can start taking Social Security as early as age 62. What has to be recognized in that, though, is that taking benefits early causes a permanent reduction in annual benefit. And we'll talk about a couple of exceptions to that. But by and large, taking benefits early, unless you do something different later on, causes a permanent reduction in annual benefit. And where this gets to be really compounded is that Social Security, the only way it really kind of goes up is if it, every year it's subject to what's called a cost of living adjustment, or COLA. Last year, that cost of living adjustment was 1.6%. It's estimated, now they're going to release this number, I think, literally next week, if I remember my associate Sean mentioning this to me as we were doing research for this. They're estimating 1.3. Now, that's not a quote. You're going to get that number in a week or two. But if we compare that against a typical annual healthcare cost rising 6% a year, it's really clear that Social Security is not keeping up in and of itself with some of the expenses that you're going to be facing here. So it's then, when you then start taking 25-30% off the table, what happens is if you start with a lower base, those living adjustments are going to be less money in your pocket. You're going to lose even more over that period of time, because that 25 or 30% you would have had you waited till full retirement is not getting compounded. So it's kind of a double whammy. And you got to be careful about that type of thing, unless you can't get around that. Now, that said, when you take normal Social Security, that's for most people now, full retirement age is usually around age 67, with some exceptions to it if you're depending on birth date, which you can find, by the way, if you're wondering what is my full retirement age specifically, you can go onto the Social Security Administration's website at ssa.gov and look that up. It's very easy to say. You just enter your birthday and it just tells you your full retirement age is this. But yeah, at age 67 is when you technically have now reached full retirement age, and you can go ahead and start taking normal Social Security. If you do that, you're going to need some documentation. Now, you should have gotten, before this webinar, you got a list of notes from us. You got a copy of the slide deck, as well as a little timeline sheet, which should help you with some important dates. So hopefully you're not writing all of this down. If you didn't get that, email me. I'm happy to send you a copy of this. Do not be scribbling down all this information, because there's a lot of it. But you're going to need a number of documents, and you're going to want to have either originals, or they need to be certified copies. And certified copies, depending on where you were born, depending on that sort of thing, may come from the city, may come from the county, may come from the state, depending on wherever it is that you need to get that document. It usually costs anywhere from $35 to $50 to get something like a birth certificate that's certified. But you do not want to be going in there with a photocopy. They can't accept that. So make sure you have either originals or certified copies of your documentation, and that'll make sure that that's a good experience for you. Now, if you're thinking about this and going, maybe you already know what your Social Security benefit is going to look like, which, by the way, if you don't, if you contact them, they can get you that number. Like, that's not a secret number or something tucked away. They can give you an idea of what that'll look like. But if you're thinking about it and going, I'm not sure if this is going to be enough for what I need or what we need overall. There are some ways to handle that. One way is one, making sure you work until full retirement age if you're considering any other option. As much as you might want to retire earlier than that, earlier than 67, at the end of the day, you got to have a minimum of 35 years of being paid into the system, or that payment's going to decrease, and making sure that you actually get to that so you get a full payout. If you don't, what happens is that they kind of scale that benefit back depending on how close you were to age 67 when you retire, or when you claim that Social Security benefit, rather. Another way to go about this is to delay the claim. And you can do this, by the way, delay till age 70 doesn't mean you have to decide at 67 that you have to commit to 3 years. Like, no. You can choose to take it at 68 or 68 and a half or 69 or whenever you want to begin that benefit after age 67 all the way up to 70. It doesn't benefit you. You can't get any additional benefit beyond 70. So you definitely want to take it by then. But every year delayed basically adds about 8% to your benefit payment for not taking in for an entire year like that. That benefit rolls in and adds in. So if you can make it, go to age 70 before starting to take payments, your payment could, will be about 32% higher through that delayed process. So right off the bat, that's a substantial increase. And remember that 32%, when COLA is added to it, well, that cost of living adjustment's now working off of that whole amount. That's an annual, the question was per month. So it's 32% higher for the whole year. So that would include, it would be per month as well, technically. So if let's say your benefit was $2,000, let's say, then you would be looking instead, or $2,000 a month, let's say. Then if you delayed that to age 70, you'd be looking at a benefit payout of about $2,650 a month, as opposed to $2,000 because you delayed it. It is a slight approximation, but it's pretty close to that number in terms of that 8% added benefit payment. So it does really pay if you can delay that, because you're basically what you're doing is saying, take years I would have taken from this system and roll it into the remaining years that you will likely end up using it, and you end up getting a much better benefit as a result. So again, depends on your individual situation. Some people, depending on health circumstances, that sort of thing, maybe that's not a good fit. Maybe you need that extra benefit now. Maybe working to 70 is not going to be possible, doable, achievable. Totally understand. But if it is something you can do, it can be very beneficial. And this is where some individual planning comes in. You can also have what's called a do-over. If you took Social Security early, say you took it at 62 or 64 or what have you, and you sat there and said, maybe there was a period of time in your early 60s where you had to have some medical work done and you couldn't work for a period of time. So Social Security helped tide you over, but maybe you've recovered, maybe your health has improved, and you can go back to work. If that's the case, you can choose at some point to suspend your Social Security benefit and say, I don't want to take that benefit anymore. And so what you can do is, if you end up, basically taking that do-over, you don't have to pay back money that you've previously received. But basically what happens is you start getting credited back for, the time that you're not taking the Social Security benefit. So in a nutshell, what happens then is that, okay, so you went ahead and took it early, you took that 20% reduction, but then you end up getting, going ahead and getting off the system for a couple of years. You can gain some, if not most or even all of what you had, lost in that pool, if you stay off the system long enough to do that. So again, this is a very individual sort of case-by-case basis to do that type of analysis and go, does this make sense for you? Can you do that? But know that you're not, once you've, if you've gone and taken it early or are considering taking it early, there is a way for you at a point decide, you know what, I don't actually need this additional money. We can go ahead and stop those payments and build back that annuity value, basically. So going on next here to spousal payments. Spousal payments are based on one of two things. It's going to be on either your own work and what you've made in your career, or 50% of if your partner is earning a higher earner is made a whole lot more. Whichever is the higher amount for you is what you get. And so this is where Social Security is going to be able to pull all that information from you. They're going to be able to see what all those amounts are for both you and your partner, and be able to say, and you're going to get this or that. And it's done automatically. They have all that information. That's not something you have to worry about. Making sure that you filed. It's not like your taxes where I have to make sure to file the certain thing the right way. No, they have a whole automated system that says this is your benefit because this is the highest amount we can give you. And their analysis is really good about that. What's also interesting is in that rule, that can also involve if you were divorced at a point. Divorcees can claim benefits based on an ex-spouse's work record. This gets forgotten oftentimes until we've sat, when I'm working with clients, until we've sat down and had some conversations about life history a little bit. But there are some conditions that come with this. And so I'll go through these, but you're going to also want to know these things as you're thinking about your own situation. You have to have been married to your ex-spouse for at least 10 years. If you're remarried, you can't collect from that particular relationship unless your later marriage ended by annulment, divorce, or death. So if you got remarried and your partner has died, and this is sometimes how that can get forgotten, is you go ahead, you get divorced. Maybe that was something that happened 30 years ago. They go off at, they've had their career in life. And then meanwhile, you go ahead, you get remarried, and your partner passes. When that happens, it is possible that that first relationship, that first person you divorced, may have done very well career-wise, salary-wise, etc., and you would be entitled to their to a benefit from that. So that's that. It's kind of feels a little grisly to think about that, but it is how this system works. Know that you're going to get either this benefit or your own benefit, but it is not stackable. You don't get this and that. You can collect as even if your ex hasn't retired, as long as you're divorced at least 2 continuous years before you apply. Both you and your ex-spouse have to be 62 years old for this to work. And ex-spouses must file for all available benefits and can't claim like a spousal benefit and delay a benefit claim on self and try to do all this at the same time. So you can't juggle between multiple pools of where that benefit would come from. The same basic rules also apply for if a spouse that was a former spouse that was deceased. So you were married, your partner passed, and now you're remarried. If that person, you could take a look at what their benefit might be, and that might end up being the highest benefit for you. So as I kind of mentioned at the beginning, it gets a little interesting depending on what your personal life circumstances are. And this is, again, where I would say sitting down with a financial planner and talking through some of these things, and or talking with someone over at Social Security is going to be a big benefit for you. Widowers also have a number of rules that come into play. Widows and widowers can start receiving benefits at age 60. You can switch to your own benefit as early as age 62, or delay to increase the benefit later on. If you are disabled and the disability started before or within 7 years of your partner's death or worker's death, you could begin to receive that benefit as early as age 50. Again, fairly specific situation, but if that's where you're at life-wise, that's a really good lever to know that you could potentially pull. If you remarry after you reach age 60, your remarriage will not affect survivor's benefits. So that something also to kind of keep in mind. Full retirement age for the widower, once you reach your personal FRA, you get 100% of the deceased worker's benefit amount. And then it scales from age 60 on if you choose to take that earlier than FRA. Finally, the one thing that kind of confuses people when something happens, to a partner, is that there technically is a death benefit that exists, which is a lump sum of $255 if you're receiving a spousal benefit. That's paid automatically. If you're not, you'll fill out an application within 2 years of the worker's death, and they will cut you a check for $255. Do not ask me why. I have looked through the internet trying to come why exactly that number is what it is, or how, or where it fits. And at the end of the day, it's just that's in the legislation. So there's that, I guess, bit of a lump sum there. Not a lot of questions so far, so I'm hopefully doing a pretty good job with this. But if you do have something, please don't hesitate to throw it into the chat here, and we'll direct that one way or the other. Increasing income. So something that does come up is what happens if you do go ahead and you're starting to take Social Security, and let's say that you're younger than full retirement age, and start earning income. Well, first of all, if you start earning income and you are full retirement age, side jobs are not going to lower your Social Security benefit. We're going to talk about what it does do, or what it can do, but I want to be real clear about that right from the get-go. If you're full retirement age, doing side jobs, consulting, contracting, and continuing to work, frankly, does not lower your Social Security benefit. If you are younger than full retirement age, and there's earning above a certain income threshold, which this year was $18,240, $1 of that benefit is going to be withheld for every $2 earned over that limit. And so, to that end, basically we're going to let you collect this up to a point, but if you continue to earn, we're not going to let you entirely annuitize this thing. And part of that is a function of making sure that there is a benefit later on for you when you actually do retire. So it's not, you're basically not allowed to just sit on the Social Security system and try to work jobs at the same time before retirement age, because clearly you're necessarily retired yet. But what does happen is, in the year you reach full retirement age, you're going to be looking at that has a ratio for that specific year for $1 for every $3 earned above a different limit. So they kind of tiered it a little bit, like age 60 to 66 essentially, and age 66 to 67 it steps up a bit. And then once you hit full retirement age, that your side income is not going to impact your benefit. But what does happen, and the big point of this, that's all minutia. This is the big thing, is if you are in your early 60s and you are taking that Social Security benefit and they end up withholding a portion of it, it goes back into building that benefit amount later on. So if you are having benefits withheld, you will get higher benefits later, meaning that, remember that 20 to 30% penalty we talked about for taking it early, you'll have less of a penalty as a result because you'll have not taken as much of a benefit earlier than full retirement age. Question regarding the widow benefit, based on the amount is the widow benefit based on the amount the deceased was collecting, or is there a cost of living increase? So it'll be based. The widow benefit is going to be based on the amount that what the deceased would have, whether it was what they were collecting or what they would have gotten from their benefit. And there will be there in all the benefits, regardless of how it's calculated, your cost of living adjustment is going to be based on what that number is. So first you figure out, here are the different numbers of, if I take my own, I get this number. If I take it from as a widow, I get this number. If I take it from an ex-spouse, which of these numbers is highest? Grab that, and then that's going to be your benefit. And then every year they're going to go ahead and make a cost of living adjustment based on whatever that number is, because you're going to keep that benefit essentially for the rest of your life at that point. General question: can both workers collect full benefits at the higher amount? Yes. I mean, yeah, it's like I said, they're going to look at each individual. And like, for example, if let's say both you and a partner are both higher income earners, you're going to, the highest number for both of you may be yourselves, and that's fine. No, it's, each one is kind of, each person is analyzed individually. So when you're looking at these different buckets, realize they're going to look at if multiple situations apply to you, like if you are both a current spouse and a divorcee, for example, you're going to go in and you meet certain requirements. They're going to take a look at all those situations that you qualify for and say, what number is going to be the highest for you? And that'll be the number that they end up picking for you, is whichever situation gives you the best result. But yeah, it's possible, like, that like I said, it depending on the situation, that you're both, like I said, if you and your partner could both, have a, for whatever reason, a higher benefit than any other situation, then that's what you'll get, but whatever that amount is. Hopefully I've answered that question right, or answered the question you asked, I should say. Let's talk about the tax impact of income. Social Security benefits are considered income, and they have up to 85% of the benefit affected by taxes if your gross income exceeds certain thresholds. So, and that threshold basically adjusts upward on an annual basis. But it's one of those things where if you have a decent sized Social Security benefit, and let's say you're doing some contracting, side work, consulting, whatever that might be, even as you're retired, what happens, it's not that you lose any of your Social Security benefit, but a greater and greater percentage of your benefit, one, is going to be subject to tax. And obviously, as your income increases, your tax rate goes up. So two things are going on at the same time. A greater and greater portion of the Social Security will be subject to taxation. And that amount, am I paying 12%? Am I paying 22%? Am I paying 24% as my top tax rate? Well, or whatever that number is, will depend on what you're earning in terms of income. Things that count as income real quick. Around that same time, starting at age 72, you have to start taking required minimum distributions from your 401k, 403b, traditional IRAs, any of those types of accounts. They require you to take distributions, and those distributions are ordinary income, which will affect your Social Security. If you ever hear of a topic of what's called a backdoor or a Roth conversion, many times people in their 50s and 60s will look to convert some of their assets from one to another. And again, that's where you sit down with a financial planner and run the numbers on this, by the way. But when you hear those types of topics of why they do that, this is why, because all those retirement assets, those distributions are considered income, just like Social Security, just like any other work you're doing. And all of that increases taxes on not only that pool of money, but increases the amount and the rate at which your Social Security is taxed as well. So what is accepted from that is if you have either money coming from a Roth IRA, Roth 401k, or an HSA, or particularly Roth IRA or an HSA, distributions and other unrealized capital gains are not considered gross income. They're not subject to taxes. So, so they're not reported on your tax return, and they won't impact either your tax rate or your or what percentage of your Social Security, because it's not income. If Social Security is the only form of income, you don't have a pension, you don't have 401k assets, or not a lot that's being liquidated, typically Social Security by itself will not be taxed, or the tax will be incredibly minimal. So again, you'll notice, like I said, there's depending on where your assets are at, what buckets they're in, and what your situation is, there could be some substantial planning things to consider here to help try to mitigate how much you're ending up paying in taxes. One benefit of being in Illinois, as much as we rip around for our property taxes and various forms of other taxation, is it is a state that exempts all qualified investment and pension income from taxation. You do not pay state level taxes on any of that. You still pay federal if it's ordinary income, but you at least don't have to pay state taxes on that. That said, this is the type of thing where you're going, hey, I've got questions. Great. I would strongly encourage a meeting up with a financial planner. I do know a guy. So hopefully I've answered some questions if you had any regarding this. But it is important to kind of keep these things in mind as you're looking at what decisions you're making and how you're going about this. So some things that kind of shifting gears a bit. The Social Security payment is one big aspect of managing and maximizing. Here is this money that's going out and whatnot, or coming in rather. But the kick of it is it's coming in and then it goes back out in a variety of ways. And so you have some options and some things that you can consider that might very well improve and let you sustain a lifestyle more readily. And I want to talk about what some of those things are. There are 5 property tax exemption programs that are potentially available for you depending on your individual situation, especially if you're in Cook County. But in most parts of the country, most of these programs exist. So if you are living in a different county, there are likely renditions of this, whether that's a senior homestead, where you just pay a lower rate, a senior freeze that freezes the tax payment and doesn't allow that tax payment to go up. There could potentially be a tax deferral program available. If you make a home improvements, there could be an exception for that to maintain like mobility and that type of thing. And there's a disabled veteran exemption as well, which if you haven't been taking advantage of it, you can do that right now, like regardless of age. Typically, a disabled veteran is like an immediate, you can do this thing, depending on the level of disability. But these things oftentimes get overlooked, and there's a lot of savings to be had by changing, even going from homestead to senior homestead can mean a substantial savings on property taxes. Another thing to really think about as you're getting into this, like I said, the sort of next phase, is making sure that we're being smart about how money is being spent. Really thinking about what your lifestyle is going to be and what your income is going to be, and making sure those things match. Being able to, you have the opportunity to receive discounts for different things, which is great, but try to avoid justifying a more expensive lifestyle because they give you a deal, or because they'll take a percentage off, for a discount or whatever that is. Like, make sure you're getting what you need. Shop, potentially maybe you're shopping used for goods or selling things you don't need. Asking for discounts on services. Many times businesses will offer, a senior discount or that type of thing. And it's just a matter of asking them for that. And the big one, and I tell all clients this, irrespective of age, borrow items as opposed to buying them. A number of clients that I have looked at, I've got to buy this wood chipper, I got to buy this or that, and I'm like, someone in your community has that item. Get on Facebook or get whatever platform of your choice and talk to people and say, hey, or ask one of your neighbors, hey, do you have this thing? I also I'm a big fan of checking out books from the library. Saved many, the library has saved me many thousands of dollars over the years, not Amazoning or Audibling or whatever, because we have this amazing resource. So, and you guys are probably the best people in taking advantage of it since you're being here tonight. So yeah, take advantage of these resources you have available. Another topic I want to talk about, and this one's a fairly personal one for me, is to be aware of predators. And what I mean by predators is this. Most people, when they think about a burglary, and that's something that frightens people, having your house broken into, having stuff stolen, whatever. And so you get Ring or you get ADT or whatever your system of choice, Simply Safe, whatever your security might be, and people spend hundreds of dollars a month, if not a year, getting these things and making sure they're protected. And the home burglary business is like a $2 to $3 billion a year business. And that is 1/12 of the amount of fraud and abuse that seniors receive when it comes to the financial damage that is done to them by predators. On average, $36 billion of fraud and abuse a year, specifically targeting seniors, according to the FBI. It is easily one of the biggest, one of the larger industries in our country in terms of crime and abuse. And so, and frankly, and why it's personal to me. So my dad's retired. He's 67 years old, and he was out, and this happened about a year ago. He was out cutting wood in the backyard, and he came in during the morning, and he was fatigued. He had been working out back all morning, hadn't really eaten a ton, and so he sat down on his computer and was surfing the internet, and he must have clicked on some bad link or something. But he got this pop-up or whatever that said for him to call the Microsoft Help Center to get some, to be able to help, restore his computer settings. Now, my dad's an incredibly intelligent individual, but the thing is, when your blood sugar drops and you're tired, or I don't know what else may have been going on, but my dad for about 15 minutes was not in his best mind, and he called. And they, asked for access to the computer, which he gave them. And it felt very odd to him as that process went on. And he recognized about 10 minutes into that call what they were trying to do, which was to steal information from him and account information and that type of thing. But by then, it was too late. Damage had been done. And so he immediately he did the right thing in contacting all of his financial accounts and closing cards, reissuing cards, everything. I will tell you that within 1 hour's time of that phone call, they had already made about $5,000 worth of purchases. They had already began processing a transaction to remove money from his bank account. And they had attempted, although unsuccessfully, to access my dad's retirement savings. And that was a real shot across the bow for me. One, as his son. Two, as someone in the financial industry. That really hit home. And I think about the fact that my dad worked very hard through his career. I mean, we were a middle low income family in terms of means, but he saved almost 30% of his pre-tax paycheck to be able to afford to retire. The idea that he worked that hard for that long in his career, where 15 minutes of not being of right mind could have wiped out 30 plus years of work. That's not okay. That does not make me feel good. Um, but you have to realize that that is a very, very, very real threat. And it can happen to anyone at any point. So it's really important to have systems and thoughts and a plan for how to handle situations like that and making sure that accounts are protected. And you are a target, a massive bullseye on you, because you typically will have the most assets, and you are not going to be necessarily the best defended. The most common forms of fraud are investment insurance fraud, having some sort of broker try to, let's say, roll over your 401k into some sort of high-priced annuity where they earn a big commission. Many times those products are not very good. That there would be regulatory concerns should someone have actually examined the situation. Well, by the time that's happened, they're long gone, and they've taken, those commissions can be as high as 10% of the balance. And it's in the fine print. And people don't, or with incredibly long periods of time to get out of those situations, what are called contingency charges. It gets very expensive. It's difficult to unwind. So that is a very common way. Insurance and Medicare fraud is another big one. Counterfeit drugs and medication, getting medications on your behalf, and or just frankly stealing them off your doorstep. That happens. Funeral widower extortion, showing up at the funeral, so you're grieving, you're upset, and someone shows up at the if you have any sort of dinner or potluck or whatever afterwards, and it's here's a long lost relative in quotes, and these people practice, they're actors, they play the part. Telemarketing scams, sweepstakes scams, impersonating a relative. And I will tell you the really nasty thing about these is that the common perpetrators of these things or accomplices to these things are family members. So there's usually some sort of connection in order to get an in to talking with you, and that's unfortunately usually a family member or a friend. So a couple of big things. One, have a plan and develop the plan now. Not 5 years from now, not 10 years from now. You can't plan for an emergency or a situation once you're in the situation. So when it comes to things that are being mailed to you, when it comes to things that get emailed to you, have a plan for, before you go and do something, is there someone you trust or multiple people you trust that you always check with before you fill something out or sign something or do something? And start getting in the habit of involving those people and having conversations. That's not easy. A, because it's a new habit, and B, in many of your cases, I'm sure you've kept your finances and that stuff sort of kind of secret, or maybe you've or private or that type of thing, or you've not wanted people to know what you're doing. It's going to be important that you have someone or a couple someones that you can trust that will help you make those types of decisions. If you haven't updated like a will, or haven't had like a will or a trust set up or that type of thing, it is also that time where you start thinking about getting in front of an attorney that can help with that specializes in that. So but have plans for filtering information and trusted people around you that will help make decisions. The other thing I would say is that especially if you see a friend or family member that isn't acting right or is behaving very oddly, and you think maybe someone new has come into their life, and you think they're being taken advantage of. My late grandmother on my mom's side had a guy that was claimed to be a religious preacher, and his name was Charles. And Charles rubbed me typically very much the wrong way when I got to meet Charles. And I was very concerned that, my grandmother started behaving differently, and my mom noticed this as well. And this is one of those things where if you think there's something going on and there might be something abusive, and abuse could be it doesn't have to be they're physically striking someone, but it could be taking advantage of them. asking them to pay for or do things they can't afford or pay, whatever to do. You have resources. Obviously, confronting it's one way, but also know that there is actually an entire division of our section of our government that is focused at the state level on handling situations like this. And so I've put the phone number in there for the Illinois Adult Protective Services. And they, like I said, it's a team of social workers, great people that are there to look out for cases like this. And so if you're looking at a situation, even if you're really just unsure, they know how to handle unsure situations and evaluate them. They have professionals that have many years of experience in this stuff. We got to kind of watch out for each other because, again, $36 billion a year, and it can literally be anybody. Chances are, if you know enough people, you know someone who has been the victim of some sort of fraud or scam or abuse. You have resources to help with that. And the reason why I take a good amount of time on this is because it's one thing to have your Social Security and your retirement and all that benefit, and then you have to keep it, and we have to protect it. And having a plan for how you're spending it's important, how you save money is important, but also making sure that, again, that you're not the target of a scheme or abuse or anything like that. To recap a bit, a timeline of applying for services, and this is pared down a bit. We also provided as an attachment before this webinar a more robust timeline of some different important dates or important times for you to look at certain decisions. It is important both with this and with Medicare. You want to be very aware of what the timeline is. You do not want to ignore this. Ignoring Social Security is less punitive because you're going to increase your benefit. Ignoring Medicare can actually be really, really costly, and you do not want to ignore that. Bottom line is you don't want to ignore either, but keep in mind these things are a bit time sensitive, and so you do want to be on top of this. Age 62 is when you can file for early Social Security, but no, you're going to have a lower benefit. Age 64 and 9 months, here's that Medicare. Apply for Medicare Part A, evaluate what other parts you want to take based on your individual healthcare and situation. Is the chart for born before 1954? You'll want to check the Social Security website if you're before 1954 because it's got a schedule for you essentially. And within a couple of years from now, everyone's going to be 67, at least until they lengthen, and I imagine they're going to eventually lengthen how long it'll be before. I think FRA is going to go up in the next few years for those people that are probably under 40 years of age. I would expect that. So it could be, or 45 for that matter. But for right now, yeah, there's a you'll want to, it would say Social Security is, let me see if I can pull it up real quick. I'll pull it up quick here at the end. Age 65, be looking at those property tax exemptions because many of those kick in at that age. Age 67, full retirement age for your Social Security benefit. And age 70 is when you absolutely want to take your benefit because you can't get any more benefit from delaying your Social Security benefit. So with that, I've kept this actually pretty tidy today. I really appreciate, first of all, if you have more questions, follow them into the chat. I'm going to try to get a link for you real quick on that age table. But if you have questions pertaining to your individual situation, you want to kind of walk through a bit, resources. One, obviously reach out to us, Steven@briggswealth.com. Happy to lend a hand as you're looking through this stuff. I also strongly encourage reaching out to the Social Security office. They have a great team of people, and frankly, they have all the information on you, so they can look at hard data for you and give you some guidance in terms of what benefits you qualify for and improve that. So, and speaking of trustee employee, my trustee employee Sean has posted a link here, which is the age reduction chart. So you can see by year basically pre-1954, 1955, 56, 57, and so on. what full retirement age is going to be. So first, thank you, Sean, for that, because that saved me 2 minutes of clackety clack. Nice. Hashtag teamwork. Other questions you might have? I did it. We did it. Pretty amazing stuff here. No, I appreciate you all very much for coming in here. Christine, did you have anything else or any questions from anything else you wanted to add from your vantage point?
I just wanted to say thanks to everyone for coming tonight. And we also want to remind you that we are recording tonight's presentation. So we're going to throw that up on the library's YouTube channel. It usually takes about a day or so to turn it around and put that up online. So if you wanted to watch this again, if you feel like you've got someone at home or friends or family that you want to share it with, that link will be available shortly. You can always email me. I did email everyone to start when I sent out the attachment. So you can just reply to that email that I sent to you guys and ask for the link, and I will share it with you, and then you can share it with others.
Yep, and the yeah, you should have like as those attachments, you should have gotten a copy of the slide deck as a PDF. So all those details should be on there, as well as a separate handout that has the timeline of when all those things are. And Sean prepared a good chunk of that, and we did some revision there. So thank you, Sean, for your contribution to this tonight. Much appreciated. I think any other questions? I think this is about as perfect as we've run this before.
This was pretty smooth. Thanks,
Nice.
Steven.
Oh, you're very welcome. Again, the last thing I'll just say is that, again, you have resources here. So take advantage of them. You have questions, you got professionals, take advantage of us. If you want to talk to Social Security and get information, take advantage of them. But be proactive in getting information so that you can do your best planning for yourselves. And of course, if you have other planning questions or retirement questions, again, don't hesitate to ask. We're here to help you.
Awesome. Thanks so much.
Thank you. Everyone have a great evening. Be well out there.